Hello and welcome to Teaching Buddha. Today in this video, we will learn about trading in stock market and also trading how to trade with candlestick charts. Every year, unemployment is growing rapidly and rate of job recruitments are not satisfying. This made everyone to look for other sources of income. Those who have good amount of principal are starting their own businesses, and those who don't are left with very less options. Especially during the times of recession like the present ongoing pandemic, it is difficult to find a source of income. Hence these days, new traders in stock market are increasing. Because in stock market, you can even have a small amount to open a demat account and start trading. You can have 1 lakh rupee or 50,000 or even less than 10,000 rupees to start trading in stock market. Trading in stock market is a game of probability. In this game, you will have 50% chances of winning or 50% chances of losing. For example, if you toss a coin and if you bet on head, you will have 50% chances of winning. You will have 50% chance of getting head. Similarly, if you bet on tail, you will have 50% chance of winning. Similarly, in stock market, it is also a 50-50 chance. So in such a game, the probability is very less and it is very risky. So in this game, there is high risk and also high reward. But if your risk is very high, why would you invest your hard-earned money in gambling? Because this is gambling. If you don't know what is going to happen and if you bet on something just in hope of winning, then it is definitely called gambling. And if you invest your hard-earned money in gambling, you will lose all money at some point of time. Because by doing gambling, more than 90% people lose money. But still, there are few people who make good fortune in trading stock market and they become rich. How do they become rich? For that, you have to become a professional trader rather than becoming a gambler. How do you become a professional trader? What is the difference between a gambler and a professional trader? A gambler has no knowledge. A professional trader will have some knowledge. So, you should have your first investment on knowledge. The first investment is very important. Your first investment should be on knowledge. Knowledge increases your winning probability. Because in the game of probability, if you increase your chances of winning and reduce your risks and cut your losses, then you can make good profits consistently. So to increase your winning chances, you have an edge over others by cleverly investing your first investment, which can be money or time, on knowledge. After gaining enough knowledge, don't trade until you are very confident. Do virtual trading for 3 months at least. That is my suggestion. And if you consistently gaining some profit every month, then do real trading with real money for around 6 months with your 10 or 20% of your money, because you don't want to lose all the money. Because It is when you put your real money, then only your emotions will come into picture and emotions will dominate. So, gaining knowledge and some experience will help you control your emotions. Your emotions should never control your trading. This is very important. To start trading, you need some analysis. You need to analyze the company and enter certain position. How do you analyze? Some people analyze using charts, some people analyze using balance sheets and following some other news, some blindly follow other traders' suggestions. And it is very most risky thing. Never follow anyone's suggestions. If someone asks you to buy something, then it is going to fail definitely. Keep that aside. There are different charts like line chart, candlestick chart, Renko chart, point and finger charts, etc. But compared to all these charts, candlestick chart is the most important chart which gives you a clear-cut vision about what is going to happen. Also, you need some technical analysis. You may or you may not know about the technical analysis, but knowing some technical analysis also would help. There are some indicators which you can place on your graph. They will indicate the movement of the market. Some indicators like moving averages, RSI, stochastics, pivot points, CPR, etc. I recommend RSI or stochastics to view if a share is in overbought zone or in oversold zone. Also, pivot points in CPR, they help you understand where there is resistance and where there is support. Keeping all these aside, your final decision must be on the candlestick signals. That should be your final decision making point. Let's go move to candlestick charts. Candlestick charts predicts investors' psychology. In trading, there are two things: greed and fear. And it also has two main directions: bullish and bearish. It can also be in sideways. Candlestick charts give signals when the market is going to be greedy or fearful. It gives signals when the market is going to be bullish or bearish. Candlestick charts are tested for around 400 years. These are developed by Japanese rice traders in 18th century. At the time, they used to track the prices of rice. These depicts change in investor psychology. Candlestick charts depicts change in investor psychology. It shows sentiments of other traders. That's what we have to know main. How other traders are thinking. Candlestick charts give you some idea when the buyers are going to buy and when the sellers are going to sell. Candlestick charts works for any time frame. You can use it for 5-minute time frame, 10-minute time frame, 15-minute time frame. You can use it for even short-term period, short-term investment also, and long-term investment also. These candlestick patterns Signals sentiments of traders. Signals have been refined, tested, and utilized in variety of markets. Candlestick charts can be used in Nasdaq, Nikkei, German DAX, or Nifty. So, candlestick charts is one for all. It works for any market, even in the real life. Candlestick charts, learning candlestick charts increases the probability of winning. Let us learn some candlestick basics in this video. There are two different candles mainly. One is green candle and another one is red candle. This is how a green candle looks like. You can see the center rectangular shape is body and the lines above the body and below the body are wicks. They can be called as wicks. They can also be called as shadows. And this is how a red candle looks like. For green candle, the body looks green. For red candle, obviously the body looks like red. This is the body, and above the body and below the body there are lines. Those lines are called as wicks or shadows. Green candle can also be called as white candle. Red candle can also be called as black candle. In some charts you can see white and black. In some charts you can see green and red. In green candle, see, in any time frame like 15-minute time frame or 5-minute time frame, the candle opens, and where the candle opens the price is called open price. Here the candle opened here, so this is called the open price. If the closure price is above the open price, this is called closure price. If the closure price is above the open price, then definitely the candle is going to be in green color. You can see upper and lower shadows. For some candles there can be no shadows. For some candles there can be either upper or lower shadow, and for some candles there can be no shadows. In the upper shadow, the upper side is called as, this is the high point. The price has reached this point and came down, because at some point of time during the formation of this candle, price has moved up and sellers push the price back until here. At some point of time the price has fallen down and buyers push the price up, and this point is called low. This is the lowest of the candle. Next is, this is the red candle. Here you can see the price has opened here and this is called open price. If the closure price is below the open price, then candle is going to be red. It is a red candle and it is called bearish candle. This is the closure price. At some point of time during the formation of this candle, you can see the price has moved up and ended here. This is the high of the candle, and sellers push the price back down. At some point of time price has fallen down and buyers push the price back upwards, but eventually sellers won the match here. Sellers took control completely and hence there is a red candle. There are different candles like that. Left one is white Morobozu, right one is black Morobozu. As I already told you, white can be green, black can be red. Here price has opened here. This is the open price, and the moment the price has opened, bulls had the upper hand, and bulls completely took control and pushed the price upwards and closed here. This is the closed price. There are no shadows either on upper side or lower side. Here the low is same as the open price and high is same as the closed price. Similarly, in the black Morbozu, there are no shadows on the upper side and lower side. Price has opened here. As soon as the price has opened, sellers took complete control. The price has closed here. Here also, the open price is same as high and closed price is same as low. White Morbozu is complete very good bullish formation. Black Morbozu is very good bearish formation. This is opening Morbozu and closing Morbozu. In opening Morbozu, if you see bullish candle, right from the beginning, there are no sellers. That means there is no shadow at the opening end. This is the opening price. And you can see there are some sellers at the closing end. So there is a shadow. Similarly, in the bearish candle, this is the opening price. And right from the beginning, there are no buyers here. And there is a shadow at the closing end. That means there are buyers here. What this shows is, in opening Morbozu, there will not be any shadow in the opening end. Similarly, in closing Morbozu, there will not be any shadow in the closing end. So in the bearish candle also, there is no shadow in the closing end. This is Doji candle. In Doji candle, you cannot see any body, either red or green color body. As you can see, this is the open price. The price has opened here. And this is the closed price. The price has closed here. Because open price is equal to closed price, there is no formation of body in the formation of candle. But there are upper and lower shadows. Because during the formation of this candle, at some point of time, price has moved up and reached this high, and sellers took control and pushed the price back downwards. Similarly, at some point of time, price has moved down and buyers took control and pushed the price back up to here. This caused the closed price to form here. Therefore, open price is equal to closed price. So this doji candle is also called as indecisive candle. There are both buyers and sellers. So this is a fight between buyers and sellers. If you see any doji candle, there is a possibility of trend reversal. If you see a bullish candle just above the open price, then the trend going to be bullish. If you see a bearish candle after the doji candle, then you can be sure that trend going to be bearish. Of course, some conditions have to be satisfied. So from these we can understand that a simple candle will give us a lot of information about the market. If it is going to be bullish or bearish, are there any buyers, are there any sellers, who is controlling the market? Everything we can understand from candlesticks. See, stock market will play with our emotions if we are not well trained and confident. Learning how to read candlestick charts will help us to interpret other traders' emotions, and this gives you an edge over others, gives us signals for best possible trade. Always find three reasons, multiple reasons why you should enter a trade position. So now that basics are over, in the next video we will learn more about other candlestick signals or patterns, including Doji candlestick in detail, and hammer candlestick, hanging man candlestick, etc. So to stay updated, I request you to please subscribe. Thank you.